before I start, I would like to give you some housekeeping things. The first one, please keep your camera off and the micro muted to facilitate the meeting. Otherwise, sometimes it gets disappear. We just get stuck. For the question and answer, we are going to try to use the chat box if we have time. We hope so that you can just make the question live. Otherwise, please use the chat box and indicate who the question is addressed to. So we just can, the person can reply. And if we have time, as I said before, we will have the opportunity to put some questions live. Having said that, let me start just with a couple of remarks on the event and on the topic that we are covering today. I think we all agree that is why we are here, that tax treaties are an important pillar of the international tax architecture, designed mainly to prevent double taxation and provide predictability and stability on the tax side for investment and trade, but also to enhance international tax cooperation to tackle avoidance and evasion. And many countries around the world are actually revisiting the tax treaty policy to better balance the benefits and the costs that they are getting for these treaties. And this implies sometimes renegotiations and sometimes even termination of some of these treaties that in some cases are actually quite old. As an agreement that they are a tax treaty implies for both sides, both parties, some benefits and some costs. And that is not always easy to estimate. There are a lot of information barriers, and this Tax Treaties Explorer database is trying actually to fill that the gap. The ability to get a good deal depends on the, of course, on the treaty negotiator skills, including the experience and the access to the information, but also information on an educated guess on the compromises that the other party can make. So we are going to talk about these issues today. We will start with a presentation by Ashima Neb from the PCT Secretariat, who is going to briefly introduce the PCT Tax Treaty Negotiation Toolkit that has been prepared by the 4 partners of the Platform for Collaboration on Tax. Those are the IMF, the OECD, the UN, and the World Bank. This toolkit includes a very good reflection of the need to have a good understanding actually of these potential benefits and costs when negotiating treaties. And in some cases, in some cases, the answer could even be not entering in this treaty negotiation and trying to find an alternative mechanism just to achieve the same policy objective. And then we will continue with a presentation by Martin Pearson on the database, the Tax Treaties Explorer. And then we will have a presentation by an expert treaty negotiator, and then followed by a panel on some research that is using the database. So let me just give the floor now. Oh, first, I didn't introduce myself. I'm very sorry. My name is Ana Febreiro. I'm working as a senior economist at the World Bank on tax policy and administration issues, and I'm leading the international tax work at the World Bank. I'm very sorry I didn't introduce myself. Okay, so Ashima, please, the floor is yours.
Thank you very much, Anna, for that introduction and for that very good summary of what the treaty negotiation, tax treaty negotiation toolkit does. Greetings of the day to all attendees. And let me begin by thanking the World Bank and the ICTD for the opportunity to present the Platform for Collaboration on Taxes, a toolkit on tax treaty negotiations. As Anna mentioned, the PCT, or the Platform for Collaboration on Tax, is a joint initiative of the IMF, the OECD, the World Bank, and the United Nations. And this toolkit, released in March this year, is the most recent one among 5 PCT toolkits released so far on critical areas in tax of relevance to countries, particularly developing countries. Can we go on to the next slide, please? Thank you. So let me begin the presentation by explaining what capacity building need the toolkit aims to aid. Detailed guidance on treaty negotiations is available under the UN Manual on Negotiation of Tax Treaties between developing and developed countries, and a link to this manual, which is continuously updated since its first release in 1979, is now available. It can be seen on your screens. Besides, both the UN and OECD have model drafts, which form the basis of the structure of most bilateral tax treaties. And these models are also regularly updated, and they include commentaries on the provisions under their respective articles. Both models are largely similar in structure, but differ in some salient features pertaining to allocation of taxing rights between developed and developing countries. So what purpose does the toolkit serve? The toolkit is on tax treaty negotiations is a shorter and crisper piece of guidance on the subject, and it is developed keeping in mind the needs of treaty negotiating teams that are new to the topic, particularly from low capacity countries. The toolkit is unique in that the guidance is developed through consensus among experts of the 4 PCT partners, including the OECD and the UN, who have different models, as well as the World Bank and the IMF, who are partners to this work. The toolkit serves as a single source of reference to guidance that is available, but is dispersed and therefore may not be most easily accessible to treaty and negotiating teams from governments who may not have established capacities. It is a practical guidebook, which includes links to several useful resources, such as a calendar of training events of the 4 PCT partners. It includes a link to the Tax Treaty Explorer tool, which Martin will present in a few minutes from now, and also links to other commercial databases. It also includes examples of some specific type of provisions, such as the most favored nation clause, the sunset clause, and also ways of displaying text for preparing a draft for negotiation. Can we go on to the next slide, please? So what are the key features of the toolkit? It is accessible and practical. It is available both in the PDF and online versions. And on the screen now, you can see links to the online versions of the English, French, and Spanish versions of the toolkit. The PDF versions can be accessed through the link to the publications tab of the PCT website, which is displayed at the bottom left corner of this slide. The online version facilitates quick access to relevant sections that a treaty negotiator may want to refer to. It is also amenable to regular updates. And let me inform you that since its release in March, the toolkit has already been updated once and in May, and further updates are expected in the coming months. Moreover, the toolkit does not set any standards with respect to treaty provisions. Those are set under the respective models, those of the UN and the OECD. Instead, the toolkit offers guidance to facilitate informed decision-making on whether or not treaties should be entered into, and if they should be negotiated, how that should be done. Let's go on to the next slide, please. So this is just a slide that summarizes the various sections of the toolkit. It includes guidance on the considerations that need to be kept in mind before taking a decision of negotiating treaties, and as well as the various steps before, during, and after the negotiation actually takes place. The next slide, please. So the first section provides guidance on why tax treaties should be negotiated. Now, typically, tax treaties should be entered into to facilitate cross-border trade and investment and free movement of skill and technology. And treaties also enhance tax cooperation between tax cooperation between the partner countries and check international tax avoidance and evasion. Now, the guidance in the toolkit recommends that treaties should be entered into for tax reasons. Non-tax reasons, such as political objectives, should not be the driving force behind entering into negotiations for treaties. And what, as Anna just mentioned, treaties typically also result in restrictions on taxing rights of source countries and may lower tax collections. And this does not take into account factors, such as an uptick in investment or upskilling that may result in higher revenues. And it's difficult to compute the cost benefit, to carry out a cost and benefit analysis. But it is at the same time very relevant for negotiating teams to carefully consider the potential costs and benefits before taking the decision to commence negotiations. And if, for instance, if a potential treaty partner does not levy corporate or income taxes, there may be no double taxation to alleviate, and therefore there may be no benefit in entering into a comprehensive bilateral treaty. Purposes such as more transparency and exchange of information for tax purposes, these objectives can be well achieved through limited agreements such as tax information exchange agreements, and there may be no need for comprehensive treaties in such cases as well. Moreover, for developing countries, it is also important that the legal and administrative framework is in place and that negotiations of tax treaties do not pose additional burdens on the administrative capacities and availability of resources for these countries. Let's go on to the next slide, please. Now, section B, this section recommends that countries formulate their tax treaty policy, link out the objectives that they want to achieve through the treaties. And this policy should include a country's priorities and the provisions that are non-negotiable and those on which a country could adopt a certain degree of flexibility. It also recommends adoption of a country's own treaty model. This could be a public model. Countries like the US have a public model, or this could be a confidential model that countries use for the purposes of treaty negotiations. But it may be useful to have one's treaty model, which should largely be based on the UN or the OECD model provisions. The next slide, please.
Ashima, you have less than 2 minutes left, please.
Okay, let me hurry through this. So in preparations for tax treaty negotiations, treaty negotiating teams must secure authorization from the respective authorities. The ministries of finance should be in the lead in taking decisions, but other stakeholders, including the ministries of foreign affairs, need to be consulted. A significant feature of the toolkit is that it recommends negotiations through a video conferencing in certain circumstances. And this was in keeping with adapting to the post-pandemic scenario. And this was also recommended by experienced treaty negotiators during the course of the stakeholder consultation when the toolkit was being developed. It also lists the logistical preparations that need to be taken into account while preparing, and some of those are listed on the slide. I'll not go into these. Can we go on to the next slide, please? So section D includes certain practical tips on negotiating styles as well as some soft skills. You can find a video on negotiating strategies in this section. And the last section, which is section E, lists out the various steps that must be kept in mind for completion of formalities, for signatures of the agreed text by both sides, the translations of texts, as well as the steps that need to be taken for a ratification of the treaties before their entry into force, as well as the steps that may be necessary after the treaty enters into effect. Let's go on to the next slide. So that was about some of the features of the guidance in the toolkit. On the slide now, you can see the views of the online version of the toolkit. And this, in fact, does show that the audience has found the toolkit useful. And this, of course, does not take into account the views of the PDF versions. I think I'll stop here and we would be happy to answer any questions that you may have. And we've shared a link of the email where the ISTE Secretariat can be reached. So thank you very much for this opportunity, and thank you for your patient audience. I think I'll hand over to Martin now.
Let me just first say thank you to Ashima. Also apologize, there was a small problem with the Spanish translation, but it's back now. You have the link to the PCT website in your chat. And please use your chat for the questions. Someone was trying to raise their hand. We will get to the live answers at the end of the event, but please use the chat for now. Thank you very much. Martin, please.
Thanks very much, Anna. Let me just begin by noting that British university academic staff, many of them are currently on strike over cuts to their pension benefits, and I've chosen to honour this commitment, but I should just mention that that my colleagues are on strike and I'll be joining them from tomorrow. So thanks very much for the opportunity to talk, and to everyone who's attended. And I want to especially say thank you to the World Bank and to the G24 who have supported this work financially and with expertise throughout the process of developing it, and also to the IBFD who have kindly allowed us to use some of their data in the online tool. So I'm going to talk through in this first presentation the tool that we've created, demonstrate how it works, and explain the motivation and the design behind it. So 3 motivations. First of all, we know that it can be time consuming and costly to analyze tax treaties. If you are preparing for a negotiation or wanting to study, review your current treaty network. You can't substitute for that work, which requires going through the treaty texts in depth, but what we can do is make some of that analysis easier, and that's what we're trying to do here. Secondly, it can be hard to communicate to policymakers who perhaps are not so familiar with the detail of treaties and it isn't their priority. When you identify that there are significant issues in your treaty network that you want to resolve, or significant problems in a particular potential negotiation. And so we want to create a tool that will help make that easier. And thirdly, we know that research that aims to study the impact of treaties, which is something that we know negotiators and policymakers would like more of, is limited in the extent to which it allows us to understand how the content of treaties impacts on investment, financial flows, and on revenues. Most of the studies that have been done by academics look simply at the impact of having a treaty or not. But if you want to know how a particular negotiated clause will affect financial flows and affect revenue, there's little research, and that's because we need data that allows us to do that study, and behind this tool is a data set that will allow for that kind of research to be done. So I'm going to be talking through and demonstrating using a PowerPoint presentation, but the website is live and you can go to it as I'm talking and explore if you want. It's at treaties.tax. It's free to access, currently in English and French. And it includes around 2,500 treaties and amending instruments. That's the treaties of almost every developing country. We've used a quite expansive definition of lower middle income country, G24 members, and African countries to try and gain the maximum coverage. There are a few countries which may not be in there currently, but most developing countries are covered. And we have 28 different treaty provisions which we've coded, ranging from withholding tax rates through to permanent establishment definitions. What the tool does is it allows a quick and easy comparison on a clause by clause basis so that you can look across the whole treaty network or a selection of countries' treaties and analyze the presence or absence and the content of particular clauses at a very high level. And it also provides some indexes which can be used for high level comparisons that look across whole treaties. And I'll discuss those more in a minute. The tool allows you to produce visualizations in different forms that you can use to communicate the analysis you've done with the tool to a wider audience without them needing to look at the treaty text itself. It's a living tool, which means that we will continue to update it. Currently in the tool, we have all treaties that have been signed up until the 1st of January 2020. We will update it at the start of next year with the treaties signed up until the 1st of January 2021. We're running with a 1-year lag because it takes some time for treaty texts to be widely available in some cases once the treaty has been signed. But also it means that if you identify any omissions or any errors, then you can get in touch with us and we can correct it. So the tool is designed to complement the kind of analysis of treaty text you would do if you were to look at the treaty text you find inside, for example, the IBFD treaties tool. And it doesn't replace that kind of analysis, but it does help you to do a different kind of analysis and a more widespread analysis than you can perhaps do if you have to look at the text of each treaty. So this slide shows all of the different clauses that are included. I'm not going to talk through them in detail. On the website, you can see each clause and a little description of what we've coded. It follows some of the main differences between the UN and the OECD model conventions and some areas which are commonly negotiated, such as withholding tax rates. Many of these are areas that are also listed as the priority areas in the platform toolkit that was just presented. So in the data set, as well as the tool, as well as the individual clauses, you then have the indices. So you have the 3 that are listed in blue on this slide. So permanent establishment definition, withholding tax rates, and then other provisions. So those indices look across the different clauses. They look whether in each case that provision has a more source-based or a more residence-based content, and then it assigns a number between 0 and 1. So 1 means that, for example, the permanent establishment definition, looking across all those different clauses, contains more source-based elements. And a number closer to 0 means more residence-based elements. And so you have that for each of those 3 components of the treaty: the permanent establishment definition, withholding tax rates, and then some of the other provisions we've coded. You also then have an overall index, which does the same thing, looking across all of those provisions. And then a UN model index, which is limited only to the areas where there is a clear variation between the UN and the OECD model. So for example, that UN model index does not include withholding tax rates where they're not specified in the UN model. So an important thing to say about the indices is that, as I hope I'll illustrate, they're very useful as ways of doing a kind of high level analysis that can throw up some interesting avenues for further research. But what they are not is anything conclusive, because they don't take into account the priorities different countries will attach to different clauses. It's impossible to know what those priorities are. So it's a very abstract way of analyzing across treaties, but hopefully, as you'll see from the presentation, it's very useful. So in compiling the data set, it was a very large task involving a team of research assistants who each coded the treaties using a template that we gave them. Each treaty was coded twice, and then any differences between the 2 coders were reconciled. And we had an expert advisory group convened by the World Bank who helped deal with any unclear elements of the coding. So the strength of the coding in this simplified and standardized form is that it enables you to compare and look across treaties very quickly and easily. the limitation is that it loses some of the detail. So, for example, if a provision is worded in a way which differs from both the OECD and UN models, that won't be captured. We will have attempted to map the meaning of the provision onto whether it looks more like the source-based or the residence-based version of that provision, but we won't have recorded that it's different. You'd need to look at the treaty text to see that. And there's a coding book online which lists some of the common variations that are found and explains the decision rules that we used in that coding process. We also don't take into account domestic law at all. So, of course, we don't know whether a particular provision is relevant to a country, dependent on whether the domestic law would give it the power to tax in that situation anyway. But as an example of what that looks like then, if you look at fees for technical services, which is one of the provisions that we code, in the data set, you'll find for each treaty a single numerical value, which is the withholding tax rate. And that will be a 0 if there is no provision giving the source state the right to impose withholding tax on fees for technical services, or it'll give the rate if there is such a provision. But within that, there's lots of decisions to make. So we don't take into account of the different ways that that might be delivered. So whether that's through including fees for technical services in the royalty definition, whether that's through a standalone article such as 12A of the UN model, or whether that's through a protocol at the end of the treaty. Nor do we take into account the difference of scope of the definition, for example, whether it includes all of management, technical service and consultancy fees, or only some portion of that. So we have to make a decision about whether or not it meets our criteria, and we explain in the coding book what that looks like. In most cases, this is straightforward and it's easy, but there are always going to be some ambiguities. Okay, let's start to look through what that looks like. So this is how the Tax Treaties Explorer looks. I'm going to work through some examples of what you can do with it now to give you an idea. So to begin with, to say at the top here, you can select the language between English and French. It's translated fully into French. I apologize to Spanish speakers that we haven't at this point made a Spanish version, but that is obviously on the agenda. There's also a set of documentation that you can find on the top right there, frequently asked questions, a how to use guide, and some more background on the data. But the main ways in which you use the Explorer are found in the dark blue box on the left-hand side. So to begin with, when you load it up, you see this default setting, and this is showing all treaties between low-income countries, that's the World Bank income definition, and OECD members. But you can select different groups of countries to compare. You can select individual countries. So here's the list of individual countries from the low-income group, but you can select from all countries covered in the data set. You can select by region and income group, and you can also select from a group of different organizations. Here's just what that menu looks like to give you an idea of what's included there. So if we take an example, what we're looking at here is a map which shows all of the treaties between low-income countries and OECD members, and they're shaded using that overall source index. So the color represents our measure of how source-based the treaties are, and pink treaties are more residence-based, through to green, which are more source-based. So if you look at this arrow, that's pointing to one individual treaty. It's the treaty between Tanzania and Canada. You can click on it and then click again to view the treaty in detail, and you get to this page, which shows you all of the data we have on the treaty. So both the index values and then the values for each clause as we've coded them. It also includes, I've circled in yellow, links to the government's treaty, public treaty web pages. So if there's a publicly available version of the treaty that's free to access on a government website, you can obtain it from those links. And here's an example of another treaty which has been amended. So because we include protocol amendments and amendments through the multilateral instrument, you can click through and see each of those from that page, see how the treaty has changed over time. So next in the yellow box shows where you can select different types of treaty. So we have treaty, we have amendments and original treaties. We retain the text even where a treaty has been amended, so you can see how it's changed. We've separately categorized treaties that are what we've called pre-independence. So that would cover, for example, treaties that were inherited at independence that had been signed on behalf of a country by its colonizing power. And also we have multilateral treaties in there. And you can also select by status. So you can look at treaties that are in force, treaties that have been terminated, treaties that are not yet in force. And the term superseded there refers to treaties which have been amended. So superseded shows the original text of an amended treaty. So then lower down, then you can select. So each of the views that you can see, such as this map view, you can do the analysis based on every clause that we've coded, as well as all the indices. And you can select them from this box here. Okay, so what I showed you before was an example that was covering the overall source index that we've constructed, and for all treaties between low-income countries and OECD members. I'm now going to show you it with a different sample. So here we're looking at sub-Saharan African countries treaties with OECD members, and we're looking at treaties that are in force only, and we're looking specifically at the technical service fees withholding tax rate. So now on this map, a pink treaty is one that doesn't have that, where our value is 0, meaning there's no right to impose withholding taxes on those fees. And then treaties are shaded from blue through to green as the rate gets higher. So you can already see that there are some countries, for example, the East African countries, that have more blue treaties, which illustrates that they have more treaties that include withholding tax on technical service fees. So let's say you were going into a negotiation or a renegotiation and you wanted to use the tool to study what's the precedent already out there that I can use to argue for my case. So let's look at how we might use the Explorer to do that. So this map view is one way of looking at it, and that gives you this high level overview. I'm going to work through the other views that you can select. So first of all, you can look at this scatter plot. So here we're seeing the same selection of treaties. Each dot here now represents a treaty with the year signed, and you can see on the vertical axis the rate, the withholding tax rate. And what you can see then is how the different treaties that have been signed between these two groups of countries capture or don't capture technical service fees withholding tax. So I've just shown, if let's say you were going to look at most recent treaties, what's the most recent treaty with the highest withholding tax rate? And it will be this one here that the arrow is pointing to, and that's the treaty between Portugal and Sao Tome and Principe, where withholding tax rate is 15%. You could click on that to look at the detail of that treaty if you wanted. So that gives you a way of just looking over what treaties are out there and the ways in which they're coded. Let's say you wanted to study by country. So if you go to the next bar chart, there we go. So here what you're seeing is for each sub-Saharan African country, you're seeing the average withholding tax rate, where 0 means there's no right to impose withholding tax in treaties in force with OECD member states. And what you can see is some countries at the bottom seem to have fairly high values, and many have a 0 value, meaning that in their treaties in force with OECD countries, we don't have any withholding tax, any provisions permitting this kind of withholding tax. You can then click on any of these countries and it will take you to a bar chart that will show their individual treaties. So I've done that here. This is Ghana's treaties. And so you can see the withholding tax rate in its treaties in force with OECD countries. You can see it's between 8 and 10% in all of the treaties. So if you're wanting to kind of study what's around there and get an idea of where precedent is that you can draw from, how a country might be likely to negotiate on this topic, this is a quick and easy way of doing it. What you can also do then is you can download these images that you've created and save them to your computer. You can also create a link to share them so that you can send it to someone if they want to open up the same the same view in the Treaties Explorer and play with it themselves. So that's a high-level overview of the Treaties Explorer. You can go and visit it at the website treaties.tax. And now I'll hand back over to Anna.
Thank you, Martin. Just on time. Thank you so much. Thank you for the interesting presentation. I didn't introduce properly. Martin is a research fellow in the ICTD and is a very good partner of the World Bank. I would like also to thank you, our donors, the ones that allowed this work to happen in the Global Tax Program, and these are Australia, Denmark, France, Japan, Luxembourg, Netherlands, Norway, Switzerland, and the United Kingdom. And with that, let me pass the floor now to one of our tax treaty negotiator experts. Now is the head of the Tax and Customs Policy Department in the Ministry of Finance in Georgia, Mary Kortzeit. I hope that I pronounced, Mary, your name correctly, probably not, and I know how you feel for it. So if you want to correct me, please go ahead, Mary. The floor is yours.
Okay, so thank you, Anna. Actually, it's difficult to pronounce in Georgian. It's Hurtsidze, but it's okay, Mari. And so good morning and good evening to everyone. So it's really my pleasure to be here and to share my experience on the toolkit and also on the data explorer. I can say, firstly, I really want to say huge gratitude to the PCT and ICT, both of them, because you are really doing a great job. And as a treaty negotiator, I really appreciate this because actually I have more than 10 years work experience in tax treaty negotiations, and it's the second time when I saw such kind of great job in this direction. First, it was when I saw the Tax Treaty Toolkit last year, and now it's the Tax Treaty Data Explorer. So I want to start my views with respect to the toolkit on tax treaty negotiations. I can say without hesitation that it is a really remarkable document because it covered all steps what is necessary for the negotiations. And for me, it is a remarkable document because it covers not only the major steps, but it also covers some minor details, which is really necessary. And sometimes if you are a little inexperienced, maybe you can skip these steps, and it's maybe also affect your negotiations. That's why I can say that's this is a remarkable document, as I mentioned previously. Besides, as Ashima already mentioned, so it covers a 5-part, and all the part is really important for successful negotiations. But my favorite part is here is part C, preparing for tax treaty negotiations. So actually, the essential part is B. All countries should have the tax treaty policy. Otherwise, it is impossible to go further. But if we see this in a technical view, preparing for tax treaty negotiation, there are no any other documents except of this. You can read this, and so if you are a developing country with low capacity or no experience, or maybe experience in another area but recently joined to tax treaty negotiations, you can't read this if you don't have these documents, and it's difficult to be learned otherwise. That's why I see this part C is my favorite part, and actually I want to recommend all parties really necessary, and for me it is necessary recommendation from my part to have non-negotiable provisions. This is really important. Before you go negotiations, you have to be prepared from your perspective what is non-negotiable provisions from your country. Another issue here is that you are recommending to have comparison, and this is also necessary to have comparison. And from my perspective, also I want to add here that when countries are doing comparisons, it is also necessary to just compare only your 2 treaties, in which countries you are going or are expecting delegation in your country, but it is also necessary to look through treaties which is concluded by in other countries. And actually, I do to look through maybe sometimes 20 tax treaties or maybe more. It's up to you what capacities you have, but it is also really necessary because when you are comparing in other treaties, when another country also concluded with other countries, you have opinion, what was their policy, what kind of articles are non-negotiable, and so you just have this information, and this is also really necessary. And I want to, I guess if I'm not mistaken, it is missed this kind of point in the toolkit, but maybe because actually recently I have not read this document, but last year I read many times and I was really impressed about toolkit. So before you are doing this tax treaty comparison, and I said maybe it is recommending to have more tax treaties, saying I want to move to the Tax Treaty Data Explorer, because this is really important to have access to the treaties. And actually, so that's why I saw that the Tax Treaty Explorer is a really unique also itself, because it gives us low capacity countries to have access to the information, which is really necessary, and it is free to access, which is also important, because from my side actually, so maybe also there are other countries representatives here and we have access to the IBFD, but everyone knows that it is not free to access and it's quite costly. And this website, there is all kind of treaties uploaded and it is free to access. I want to tell all other delegates from developing countries that use this and use all data. And so I want to once again to say thank you for this opportunity to ICTD for this. Also for me, what is important and significant here, that and this is unique for me, some summary how it is. So it's actually simplify your life, if I can say it another word, because this is summary, and so it is already a recommendation to open the treaty, and so we know how we are going on that. But if you don't do this summary, the clauses and indices, this is all important information they put here, and it's really useful also. And once again, we can see and we compare and contrast all other tax treaties, and otherwise what we have to do and spend a lot of our times. So it's up to you. Maybe you can do yourself, or maybe you just go this way and just open this Tax Treaty Explorer website, and you can see all kind of information there here. And from my side as a tax treaty negotiator, just I have my appreciation, because I would be happy if I had this 10 years ago, and my life would be more easier. But so now all countries and all delegates who are new tax treaty negotiation, please go for it and take this opportunity. And besides, what is the clauses you are giving? Actually, I also want to touch the clauses. Actually, this is the main issues where we in which areas negotiations are going for, and this is the issues. If we don't agree with another countries, then you have to go to for the second. Actually, second round of the negotiations. Actually, all important issues are here. So this was my appreciations, but I also want to add, so it's not only appreciations here. So my recommendations would be here, maybe this is for both, so for PCT and for Tax Treaty Explorer as well. Maybe we can elaborate a bit with a suggestion how to elaborate countries on their tax treaty policy. Maybe give some suggestions. It's difficult, I agree. So I share this view because all countries should have their policies, but maybe somehow it would be possible. And also I was thinking maybe there will be some kind of work and we only concentrate not only theoretical knowledge what we have, but maybe we will also concentrate some case law, some, just example of countries A or B or C, and some very to start with simple cases. We also read such kind of cases at OECD and maybe more and UN model as well, but maybe we just change direction and somehow also work to see in practice how it works. And this is not be only theoretical knowledge or like this. So once again, actually, thank you. And so if there are any other questions, always from my side.
Thank you, Mari. Thank you so much. Thank you for your insights, for your recommendations as well. I agree that the treaty policy is very country specific, but maybe some good practices could be shared. And also for the good feedback on the PCT toolkits that the 4 organizations really work hard on, and also on the database. I just wanted to remind the participants that you can use the chat box for your questions, that they will come back to them after the panel discussion that is going to start now. We are going to have 3 panelists present their research based on this Tax Treaty Explorer. Martin Hirschon again, Tatiana Falcao, and Milan Narodsky. So let me pass the floor to Martin again. Martin, please.
Thanks very much, Anna, and thanks, Mari, for those comments as well. Okay, so I'm going to present here some illustrative findings from research we did with the data using the Tax Treaties Explorer. We really hope that in the coming years there will be much more research using this data. But this is just an attempt to show some of the things it's possible to find when looking through the data. I should say that last week, the ICTD organized a research seminar that aimed to try and identify what new research should be done, not only using this data, but more broadly to help developing countries in their tax treaty negotiations and policy making. And I think in the coming months and years, we should see a whole new range of research that's informed by those discussions. Next slide, please. So the research I'm going to talk about is presented in 2 working papers, which are available from the ICTD website. The first is a World Bank paper written by myself with Marco Carreras, one of my colleagues, and Anna Custas at the World Bank. And that introduces the data set. It talks over the methodology through which it was developed. It analyzes the existing research on tax treaties that may be of relevance to developing countries. And it shows some of the new findings that we can develop using this data. And the second is a working paper published by the G24, who also supported the data set, which then looks specifically at what we learned about the treaties of G24 countries when we analyzed them using this data. Okay, next slide, please. So I'm going to talk in 2 parts. The first is going to be illustrative findings, so some descriptive data that looks at the whole network of tax treaties that have been signed by developing countries, and draws some overall conclusions. And then after that, I'm going to talk about a replication study that we did, which looks at tries to show how the new data can change what we know about tax treaties. Next slide, please. So I'm going to show you several charts which all look like this. So let me tell you what you're looking at. You're looking at a measure of all of the treaties in the data set, all of the 2,500 treaties as they change over time. So each dot on this chart represents the average values of treaties signed in a given year. So that's the flow, if you like, of new treaties and amendments as they come through. The solid lines represent treaties in force at a given time. So that's the stock of treaties that apply at any given moment. So what you'd expect is that a trend in how treaties are signed will show most quickly in the dots, and then gradually as those treaties come into force, add to the existing body of treaties, replace old treaties, that will start to be reflected in the line as well. The dots and lines are then shown on this axis. So time along the bottom, starting in 1970, and average values along the vertical axis. And on this first chart, you're looking at some of the indices, the indexes that we created using the data. So the gray line shows the overall index, which remember is a rough approximation of how source-based a treaty is, using the comparison that I described in my earlier presentation. Then the yellow shows specifically the index for withholding tax rates, and the green shows the index for permanent establishment definitions. So what you're seeing here, remember, higher on this axis means more source-based. So what you're seeing here is that the gray line increases until the mid-1990s, and then it flattens. So looking at treaties as a whole, there's something going on that makes them more source-based until the mid-1990s, and then it plateaus. We can understand what's going on if we look at the yellow and green. What we can see is that from the mid-1990s, withholding tax rates in treaties have been declining. Remember, this is all treaties signed by developing countries, whether that's treaties with other developing countries or with OECD countries. You can see withholding tax is declining, and you can see permanent establishment definitions becoming wider, becoming more expansive, and therefore more source-based. So that's the broad overall finding. Let's decompose that a bit in the next slide. So this is showing what's happened to the individual withholding tax rates. So in this slide, everything, all the solid lines represent the different withholding tax rates. One of the things that you might notice is that withholding tax rates are, one of the things you might notice is that we have here coded different dividend rates, both qualifying and portfolio. In the data set, we also break out certain specific interest rates and royalty rates. What you can see is a steady decline in all the different rates, although the rate at which they're declining is different for different rates. And then the dashed line shows how many, the proportion of treaties that have a technical service fees withholding tax, and you can see that's increasing significantly over time. So the story is declining withholding tax rates, but counteracting that is more treaties, including the technical service fees withholding tax. Next slide. Permanent establishment provisions is more complicated story. So here we're showing the proportion of treaties that include each of these provisions. And these provisions are all framed in a way where we're looking at whether or not the most source-based version is included. So what you can see is some elements of permanent establishment definitions over time, the whole treaty network is becoming more source-based. And in others, actually, the opposite trend is occurring. So for example, the service permanent establishment, that's the yellow line, is becoming much more common. In contrast, the agent maintaining a stock is becoming less common in treaties. So you can see that although, as I showed earlier, looking across all the different things we code, permanent establishment definitions are becoming more expansive and more source-based. There's a different trend for different elements of the permanent establishment definition. Next slide, please. So now let's look at some of the changes that have been happening in recent years in the way the model treaties are structured. So first of all, we'll look at 3 provisions that we code in the data set that have changed in the model treaties. And here we're not considering changes introduced to treaties through the MLI. I'll do that next. So we're looking at 3 things. So in blue, you see Article 13.4 of the UN model. That's capital gains on land-rich companies. That's the provision which helps to deal with indirect transfers of assets. In 2003, that was added to the OECD model, having already been included in the UN model, although the wording differs. And you can see that those type of provisions have become more and more common over time, and maybe the number of treaties signed that include them has grown as a result of them being included in the OECD model, but that's a generalized trend which we can see throughout time. If you look at the yellow, that shows the technical services withholding tax. What I think is interesting here is if you just look at the last three dots, three yellow dots, you see how much higher they are. So those are the treaties signed after the 2017 update to the UN Model Convention, which included Article 12A for the first time. So you can see the impact of including this provision, which was already common in a minority of developing country treaties. You can see the impact of including it in the UN model. It became much more common. If you look at the entitlement to benefits, that's the green, you can see a really massive increase in the proportion of treaties including it in the last couple of years. It's now in the majority of new treaties that are signed. And you can see that that was a generalized trend that happened before the 27 updates to the UN and OECD models. So although those updates definitely significantly increased the proportion of new treaties that included it, they reflected a growing change in treaty practice anyway. Okay, next slide, please. Let's look at how the MLI has changed things. So there are 4 provisions that we coded in the data set that can be affected by the MLI, and they're listed here. 2 of them we've already looked at, 13.4 and 29, entitlement to benefits. What I think is particularly noticeable on this chart, so here you're looking at the treaties in force that include these provisions. What I think is particularly noticeable is that since the MLI came into force, it's Article 29, it's the entitlement to benefits where you see a real change in the treaties of developing countries, the content of them. You see here a massive increase in the proportion that do include and that will include if all MLI positions, if the MLI is ratified by all the countries that have already signed it. A massive proportion that would include that clause, although it's still less than half. What you also see, though, is that actually some of the other clauses are not affected that much by the MLI itself. The MLI will only affect a small proportion of developing country treaties in comparison to the changes that were underway anyway. If you look at, for example, the growing proportion of treaties that include 13.4. So this is the kind of analysis we can start to do using the data set. Next slide, please. So what I've done on this chart is looked at renegotiations. So here I've plotted each renegotiation that we have in the data set since 2010. And you can see the way I've done it is along the horizontal axis, we have the overall source index value for the original treaty. And in the vertical axis, we have the overall source index value for the new treaty. So anything that's above that blue line is an improvement in the overall source protection for source taxing rights in the treaty. Now, because the index is a very abstract thing, the dots that are close to the line, we can't be sure that that's anything other than an artifact of the way the index is constructed. But if we look particularly at, next slide, please, at these 4 treaties, these are the ones where there's a real significant change in what's measured by the source index. And I would say if you were looking for examples of countries that have really successfully renegotiated a significant increase in source taxing rights across the board in treaties, these would be the 4 renegotiations to look at based on the data set. Of course, the next step, once you look at a chart like this, is to look at the text and see what changed. But this is just an idea of how you can use the data set to start to spot trends. Next slide, please. Okay, so this is a chart that has been created with the Treaties Explorer website. It shows each dot here is a new treaty signed by either India or China. India is in green, China in blue, with lower income countries. And I put it up because what it shows, we're looking at the overall source index, is a real change since 2000. You can see that the way that China negotiates compared to the way India negotiates with developing countries has changed. China has become much more favorable to residence-based provisions in its treaties with lower income countries, while India has, if anything, become more favorable to some source-based provisions. And so that just illustrates that you can start to anticipate what might happen in a negotiation by exploring the different trends in the data. Next slide, please. So I'm just going to mention briefly the replication study that we did in the paper. Next slide, please. So there's a lot of research that looks at the impact of tax treaties on investment flows and revenue raised in developing countries, but it generally just looks at the presence or absence of a treaty. So we looked at quite an old paper now from 2009. And this paper found that when two countries sign a tax treaty, you can expect the stock of foreign direct investment between those two countries to increase by around 30%. So that seems like a significant finding. The big caveat is that this is an old treaty, an old study, and it doesn't really account for treaty shopping. So we can't be sure that what we're seeing here is new investment rather than simply the routing of investment through this treaty for treaty shopping purposes. Newer studies do attempt to control for that. So what we're doing here is not necessarily trying to show a real finding that we can base policy on, but rather to show how a study can be, how the new data can change what we learn in existing studies. So what we did is we replicated this study, and instead of asking what happens when you have a treaty or don't have a treaty, instead we asked what happens when the content, based on the content of the treaty. And what we found was, if you look at that overall source index, a lower overall source index, that means a more residence-based treaty, one that looks more like the OECD model and has lower withholding tax rates, you get a higher foreign direct investment. But when you decompose that into the individual indexes, what you find is it's only the withholding tax rates that drive that change. So lower withholding tax rates in a treaty lead to higher foreign direct investment flows, with the caveat that this may just be treaty shopping. But all the other provisions, whether or not they are source-based or residence-based, seems to have no effect on foreign direct investment. So that's just an example of the kind of replication that you can, the kind of research you can do using the data. As I say, it's a proof of concept. It's not intended to be very policy relevant because it's a replication of such an old study, but it gives you an idea of what we hope to do in the coming years. Next slide, please. So this is just to conclude. What we hope is that with this new data, we can do more relevant research. And in the long run, treaty negotiators and policymakers can use that to create stronger treaty networks. I'm going to hand over now to Tatiana.
Thank you, Martin. And thank you for the invitation to speak about the Tax Treaties Explorer datasets and for the ICTD for commissioning that work. My name is Tatiana Falcão, and I am the coordinator at the Coalition of Finance Ministers for Climate Action at the World Bank, and I'm also a consultant for the African Tax Administration Forum. So I'll be talking today about a paper I wrote with Bob Michel on the taxation of profits from maritime shipping across the world that emphasizes the policy decisions that can be derived for the African subcontinent. So next slide, please. Yeah, so when Bob and I started doing research for this working paper, we essentially wanted to find out whether the only successful policy towards the allocation of taxing rights and profits from international maritime shipping was in fact exclusive resident state taxation. As you will be aware, the principle of exclusive resident state taxation is embedded in Article 8 of the OECD model and has been part of the tax treaty model since the inception of the international tax regime by the League of Nations in the 20s. Ever since, it has been considered a stable rule of bilateral tax treaty practice. The reasons that justify the policy of exclusive resident state taxation have not been changed in the last 100 years. Well, we wanted to know why. Well, first of all, historically, states have been granted reciprocal exemptions from income tax on shipping companies from the other states. And these exemptions make perfect sense if the flow of the flows of shipping activities in both directions are more or less equal. Secondly, from the inception of the international tax regime, it was believed that the standard PE rule for business profits was not suitable for the business of international maritime transport. The compliance burden of having to determine whether the PE threshold was met in every port state and the difficulty in apportioning profits to any of the port state PEs was seen as insurmountable obstacle that justified a specific exception for business profits from international shipping. So that is why exclusive resident state taxation has been adopted as the default rule. So, I mean, the rest is a little bit history. Exclusive resident state taxation became the negotiation standard in the growing tax treaty network and certainly between OECD member countries. The rule has been and is a very stable element of tax treaty policy to date. Without going into too much detail here, before going into the research itself, I would like to focus on how the resident states, which are the ship owner states, have exercised their exclusive rights to tax on shipping profits. A big portion of global mercantile fleet ownership is concentrated in a handful of big multinationals located in a few countries. Most of these ship-owning countries employ generous tonnage tax systems to protect or expand their domestic fleets. So these preferential regimes have been approved under the OECD BAP's Action 5 framework on harmful tax practices. Also, in the upcoming two-pillar agreements, it is expected that the international shipping companies will not be affected. It will not be affected in practice under Pillar 1 because of the size of turnover and the size and turnover thresholds. And under Pillar 2, a formal exception has been added exactly because tonnage tax systems are simply not compatible with the idea of a minimum tax. So the effective tax rates on international shipping profits have been low and are likely to continue being low in the foreseeable future. I should mention that even at the time of the League of Nations, there was an awareness that exclusive residence taxation of shipping profits did not detract from the fact that port states had a valid theoretical claim to be allocated some taxing rights to profits from international shipping with an access to its territory. But it would, of course, take about 6 decades for this thought to crystallize in the adoption of Article 8, Alternative B. The 8B model provision and commentaries have never been amended since the 80s, when the first edition of the UN model came out. As a matter of fact, very little attention has been given to this article by scholars, and the general perception arose that this article simply reflected bad policy, given that it has been it has been fully endorsed in treaty practice. We wanted to therefore find out why this was the case, and also whether developing countries that have not embraced it, like coastal countries in sub-Saharan Africa, could learn a thing or two from the treaty practice in those countries that have. Ultimately, the research could also serve the purpose of giving the UN Tax Committee a good foundation to consider updating the model provision and commentary, which has not been amended for the last 40 years. So if we have the next slide, please. So to give you a clear picture of the debate, here we have the 2 competing rules reproduced in the slides. First, Article 8 of the OECD model, which is equivalent to Article 8 Alternative A of the UN model, and provides for exclusive resident state taxation. And then article below that, Article 8 Alternative B of the UN model, which provides for shared taxing rights. The rules here is for limited taxing rights for the source state and residual taxing right for the resident states. So if we analyze the provision more closely, it is possible to identify 4 predominant rules to Article 8B. The first rule is the income covered by 8B, which is characterized as the profits from the operation of ship in international traffic by a resident enterprise, and that greatly assimilates option A. Then you have a rule for source state taxing rights, which identifies shared taxing rights for income covered from activities that are more than casual. Then you have a rule for residual taxing right for resident enterprise or enterprise with a place of effective management in the States. And this rule provides relief for double taxation through the credit or exemption options. As you know, relief from double taxation is in fact the sole reason why a source state wants to enter into a tax treaty. Because actually, based on its own sovereignty, a source state can always tax income with a certain access to its own territory. And then finally, the 4th rule is the method of taxation in the source states. And the model provision in Article 8B refers to taxation on a net basis based on appropriate allocation. There is little guidance on the allocation in the commentary, and this is also one of the main points of criticism raised against 8B in the UN model. It does not propose a complete and workable solution. Besides these 4 main rules, the model article also suggests that the source state should accept to reduce the tax at the ordinary rates on the income that is allocated to it, and the rate of reduction is open to negotiation. So you see, Article 8B is an interesting article. It defies the core principle of exclusive resident state taxation of shipping profits, but the solution it proposes comes with a lot of gaps and open questions. So the next step is to see whether 8B has been embraced in treaty practice and by which countries and to what degree. So for this analysis, we were lucky to have been able to rely on the ICTD Tax Treaties Explorer. Next slide, please. Next slide. So there are currently about 3,500 bilateral tax treaties in force. Our primary research showed that except for a handful of mostly terminated tax treaty, previous slide, please. None of this huge number of treaties incorporates a literal or quasi-literal copy of Article 8, Alternative B of the UN model. This doesn't mean that there are no treaties that provide for source taxation. It means that they use their own wording, which is not necessarily the same as the one used in the model. So luckily, we didn't have to read through the 3,500 individual tax treaties. We used the ICTD Treaties Explorer, which allowed us to search a broad search query to identify in a few clicks those treaties that do provide for source taxation. These are represented here in green. The pink lines are treaties that provide for exclusive resident state taxation. So you see, there isn't a lot of green on the global scale, but there is a strong centralization of the green lines in certain countries in South and Southeast Asia. Next slide, please. So in the next step, we focused on the body of tax treaty that the ICTD Tax Treaties Explorer had identified in containing source state shipping rights. The data revealed that 266 out of 1,876 treaties have source taxation of shipping income. This is a very low inclusion rate, and it's actually 14% to be more exact, which makes Article 8B one of the least successful UN model deviations. But the question then remains as to whether this is actually bad policy. Well, not really. First of all, 8B is not relevant for landlocked countries. Unlike any other type of income covered in tax treaty, 8B is only relevant for a certain type of country, a source country with sea access, meaning that it has a small domestic fleet, but serves a high volume destination for transport by shipping companies from other states. Secondly, the data shows that 8 countries in the South and Southeast Asia are responsible for 200 out of the...
Tatiana,
Yes?
the interpreters cannot follow you. You need to slow down, please. Sorry.
Sorry. So the data shows that 200 out of 266 8B tax treaties are currently in place in South and Southeast Asia. In other words, 8B treaties are rare on a global scale, but they are very concentrated in a certain number of countries. And the countries and concentration rates are on your slide. They are Bangladesh at 91%, India 17%, Indonesia 19%, Myanmar 100%, Pakistan 43%, the Philippines at 100%, Sri Lanka at 95%, and Thailand at 86%. So we realize that these are the countries to look at to see whether source taxation of international shipping profits is a workable tax solution. So if we can go to the next slide, please. I have already mentioned that mercantile fleet ownership is generally concentrated in a few ship-owning countries. Just like 8B is not relevant for every developing country, it's not only relevant to developing countries that are port states. But for these so-called port states, the inclusion of 8B is obviously relevant, especially in the tax treaties with the biggest ship owner countries. So it makes no sense for a developing country to pay up bargaining capital in treaty negotiation with the OECD country for the purpose of convincing the other one to include 8B if this OECD country does not have a sizable mercantile fleet that generates traffic that involves that developing country's ports. So this table actually demonstrates the status of the relationship between 8B countries in Southeast Asia and the biggest ship owning companies in the world, and whether their source countries can effectively tax shipping income at source. So for a source state, there are 2 ways to exercise taxing rights on non-resident shipping income. They can either have a treaty in place that incorporates 8B or have no treaty at all. In that case, there is no treaty hindering the exercise of source state taxing rights, but the taxpayer will not obtain relief for double taxation in the resident states. So you see that some countries like Bangladesh, Sri Lanka, and Thailand have 8B in place with all the big ship owning countries. A country like Myanmar can also levy source tax, but simply because it has no treaty in place with the biggest ship-owning countries. And for Indonesia and Myanmar, the biggest economies, it is much more difficult to have 8B treaties in place. They do not have 8B treaties, but they have 8B treaties, but not with the biggest ship-owning countries, which makes these treaties less relevant. Another important conclusion is that all of the 10 biggest ship-owning companies have an 8B treaty in place with at least one developing country. So the idea that these resident states outright reject 8B type approaches in their tax treaties is untrue. This is important information for other developing countries intending to include 8B in their tax treaties with the ship owner countries. So next slide, please. So we then started reading the 200 tax treaties to see how the lacunas from Article 8B in the UN model were filled in practice. We focused on the relevant treaty provision, but also on the domestic tax law, because as you know, domestic law creates the tax liability. To tax non-resident shipping company income, domestic tax law has to subject this income to tax, and the treaty has to allow the income to be taxed in the source country. So we have no time to go into the details, so I will concentrate on a few quick findings. You'll see that the treaties give source state taxing rights only to maritime shipping and not to air transports. And so the principle in tax treaties of exclusive resident states taxation on air transport income is much more solid than that of maritime transports. You'll see also that with regard to the methods of taxation, all countries are neutral in their tax treaties, but the domestic tax law provides for tax on gross income. As I mentioned earlier, the UN model suggests net taxation. So in reality, this has not happened. Developing countries like withholding tax rates, developing countries like withholding taxes on gross income. This might be a point where the UN Tax Committee could develop additional guidance going forward. And with regard to the sourcing rules, there is a wide variety of policy options. Some countries apply 8B to profits derived in the source state, which makes it unclear whether this means activities taking place in the source state or payments made in the source state. But in the domestic law, the situation is different. Most countries apply a source rule that applies to payments made for transport provided by a non-resident. So in reality, the combination of these two rules means that in most cases, only local payments for transport taking place in the source state are subject to source tax. Can we go to the next slide, please? So this is, the next slide will be a continuation table, and you'll be able to read it later more thoroughly when you get the slides. And if we go to the next slide, I'll just cover briefly one of the conclusions. And you can see that the conclusions derived from the paper come primarily in the form of a question. And that is whether, based on the experience of countries in Southeast Asia, other coastal developing countries like the coastal countries in sub-Saharan Africa should adopt Article 8B. The answer is obviously complicated, but there are a few considerations to be made. While there are valid reasons to start with to adopt the article, firstly, to generate new revenues, because port infrastructure in the context of climate change will require an incredible amount of investment to start with. Then source taxation might help protecting and developing a domestic mercantile fleet. Another reason might be that source taxation might give port states a tool to create environmentally related taxes. And that could be through the application of differentiated tax rates by function of environmental footprint of ships, which is likely to be a new form of revenue generation as well, especially after the negotiations occurring under the COP26. But there are, of course, some important macroeconomic considerations to be made. Depending on the allocation of a country in the international shipping network, source tax might affect the cost of trade for a country. The Southeast Asian countries are situated in the east-west shipping lanes. Therefore, a source tax has less impact on the cost of shipping for them. Whereas in African countries, that might not be the case because they are not as well situated in the shipping network. An alternative, which has been already been suggested by the League of Nations in the past, but which has never been studied more broadly, is to provide different tax treatment to outbound and inbound transports, with only outbound transport being taxed. This would, for instance, prevent food cost increases. So it's also an option. So if we go to the next slide, I'm not going to cover this slide. You will probably have access to these slides later in the presentation. This covers a few policy alternatives for drafting an 8B style provision. But if we go to the next slide, you have a link to the paper, which you can access and read through our conclusions if you have interest on this topic. Thank you very much, and my apologies for exceeding my time a little bit.
Thank you very much, Tatiana. Let me remind the participants that we have the Q&A function. There are some questions already answered there. Please use it. Lucas, the floor is yours.
Thank you so much, Anna. My name is Lucas Millán, and I'm a senior researcher at the Tax Justice Network, also a representative at the Platform for Tax Good Governance at the European Commission. I will be presenting on the topic of tax treaty aggressiveness, which we will know the meaning in just a bit. Next slide, please. So we'll start with challenging a couple of common assumptions. Next, defining or explaining how we conceive aggressiveness and presenting some results and specific insights for tax treaty negotiators. Next slide, please. Next slide. Okay, so first of all, the common conception that tax treaties are needed to prevent double taxation, we know from existing research that there are unilateral provisions or laws that can help solve most of double taxations through tax credits. So a tax credit at the country that receives the payment for the tax paid abroad. Also, some treaties can create a dynamics of economic control. That is because although the domestic law changes, the tax treaty may remain in place. So this is the case, for example, for the Vietnam-France treaty with a very, very low withholding tax on interest. If the country, for example, decides to reduce its dependence on foreign creditors, it might want to increase its withholding tax on interests, yet this treaty would prevent that domestic policy to have a significant effect. Also, commonly, as we've seen, there is this conception that tax treaties might increase foreign direct investment. So there are meta studies, so studies analyzing all studies made up to a certain point in time. So the most recent one shows no significant effect of signing a tax treaty on foreign direct investment. Also, it's worth noting that research shows that from 40 to 80% of foreign direct investment is what we would call phantom FDI or mergers and acquisitions, which is not a real economic activity. So even in cases where FDI might increase, it might not mean real economic activity. And finally, research also shows that foreign direct investment often leads to worsening of labor conditions and environmental degradation. Next slide, please. We've covered this already about the different types of models. The OECD one protecting the interests of capital exporting countries, so the countries where the investors reside, whereas the UN model tends to favor source countries. And there are new models arising, such as the one of the African Tax Administration Forum. Next slide, please. Also similar to what has shown before, there has been kind of a decrease of withholding tax rates since the 1980s, and a slight increase of the services withholding through 12A. Next slide, please. This is an important point because, as you may know, the vast majority of treaties have asymmetric language, so asymmetric design, meaning that it applies interchangeably to one treaty partner or the other one. This has the result that the treaties by design favor capital exporting treaty partners. So like in this graph, we show that capital exporting countries, the lines in red, are actually like a very small a minority of the overall treaty making countries. Next slide, please. So these are some estimations that have been done of the annual tax losses from tax treaties. The last one by Jansky includes foreign direct investment elasticity, so how the economics change in reaction to the treaty. Next slide. We're not going to talk about tax losses, but about losses in tax rights. So the questions that we seek to answer is which countries are most aggressive in reducing taxing rights and how the different measures of this aggressiveness can be measured. Next slide, please. Next slide. Okay, so how we define aggressiveness is an aggressive treaty which reduces source tax rights more intensely than other treaties in force at the source jurisdiction. So this underlying is the idea that domestic resource mobilization is necessary for sustainable development goals, and source taxation is needed for those. To finance infrastructure, health, and other things. Next slide, please. So this is an example of like how like a treaty can be aggressive. Next slide. So what data is available and what different types of aggressiveness. Next slide. This is we use two different sources of data, IBFD tax treaty tables and the new Tax Treaty Explorer database. The only point in common of these two databases is the withholding taxes on dividends, interest, and royalties. Some data that we cannot find in the Tax Treaties Explorer are domestic rates for dividend, interest, and royalties, which we will use for one of our models. Next slide. Next slide. Next slide. This is like the conceptualization of our model is, for example, here for Rwanda, and specifically for dividends, we compare the dividend rate between Singapore and Rwanda to the dividend withholding tax for all other Rwanda treaties. So like if the rate for one treaty is significantly lower than the rate for other treaties, it means that the treaty is aggressive. Next slide. So we will focus on three different models. So in the example before, we spoke about dividends. So dividends are included in one of the dividends are included in all of these three models shown with the red arrow. But the first one looks only about on treaty withholding taxes. The second one compares treaty withholding taxes with the domestic withholding taxes, and the last one compares the tax treaty explorer indices with regards to withholding tax, permanent establishment, and other provisions. Next slide, please. Next. So these are our results to the question, who is undermining tax rights in Africa. So we find that with regards to tax treaty withholding taxes, the countries that are most aggressive in negotiating lower withholding taxes from African treaty partners are the United Arab Emirates, Mauritius, and France. And here the lines in gray and in blue are the two different sources of data that we've used, IBFD and the Tax Treaties Explorer from ICTD, and we see that results are broadly comparable. Next slide. This is the model that compares treaty withholding taxes with domestic rates. And here we see that broadly the same results, United Arab Emirates, Mauritius, and France, and we have the United Kingdom adding to the pack. So this means that the United Kingdom, although it is not so good at negotiating, or not so bad at negotiating tax rates under that are significantly lower than other treaties, the United Kingdom is good at negotiating tax rates that are significantly lower than domestic rates. Next slide. This is our most comprehensive model, let's say, which includes not only withholding tax rates, as we've shown in the previous models, shown in blue, but also includes permanent establishment and other treaty provisions. So, like, what does aggressiveness mean with regards to permanent establishment? This means that a treaty includes permanent establishment exclusions that are not found in the other treaties of the African partner. So here the biggest aggressors are France, the United Kingdom, Italy, and Germany. So all European countries. Next slide. So this is an example of how we can see that different countries, so these are the three most aggressive treaties for selected countries. And we see, for example, that Mauritius and the United Arab Emirates are very aggressive with regards to withholding tax rates, whereas France and the United Kingdom are aggressive with regards to permanent establishment. Next slide. So here is like the specific insight for tax treaty negotiators of how they can use these measures of aggressiveness to spot the loopholes or the weak spots of the tax treaties of their own countries. So, like in this case, our sample includes all treaties signed by enforced at African countries. So here, the interesting columns are first, like the intensity of aggressiveness of that treaty. This is just like a ranking for the most aggressive Senegal, Qatar, to the least aggressive Guinea with UAE, and the cells in red. So this means how much of the overall aggressiveness that is received by the African country, how much of it comes from this specific treaty. So, for example, like in the Treaty of Mozambique and the UAE, next slide, please. So, like here we can see, so like the withholding tax rates for all of the Mozambique treaties, and for example, services taxation is 0%, so there is no services withholding tax in many of Mozambique's treaties. So this means that the zero withholding tax with the UAE is not actually aggressive, because it's common in Mozambique's treaty network. However, we see that the 0% dividend withholding tax is very aggressive, because it's not found otherwise in the Mozambique treaty network. So that's why, among other reasons, this treaty is singled out as the most aggressive treaty for Mozambique. And renegotiating certain clauses within this treaty would, in some ways, close loopholes. Next slide. So this is like the same table as before, but with a different model, in this case, domestic and treaty rates. Next slide. So here we see that in these three, actually, quite aggressive treaties of Sierra Leone, Norway has the most aggressive one. And that is because with those 000 withholding taxes, it significantly reduces the domestic withholding tax rate that would be applicable otherwise. Next slide. And this is finally for the source index model, we will see the case of Portugal and Guinea-Bissau. Next slide. So here we can see that Guinea-Bissau has a multilateral tax treaty with Benin, Burkina Faso, etc., and a treaty with Portugal. So we can see in this case that the permanent establishment provisions in the treaty with Portugal are significantly more aggressive towards Guinea-Bissau, providing for non-taxation of several activities such as delivery or stock agent or insurance activities, which would be like not taxable in Guinea-Bissau for companies resident in Portugal. Next slide. Next slide. Finally, like some cluster analysis, we see that Gulf countries, Seychelles, Mauritius, and China are particularly aggressive with regards to withholding taxes, whereas, next slide, EU, OECD, G7, and G20 are very aggressive with regards to permanent establishment and other treaty provisions. Next slide. So, yeah, next slide. Finally, we can say that with our research, we show that the high-income treaty partners of African countries reduce with taxing rights the most, and therefore undermine domestic research mobilization of African countries. The specific insights we can derive are that through our methodology, we can target specific provisions in existing or potential treaties to see how much the renegotiation or cancellation of a treaty would close loopholes that are currently available under a country's tax treaty network. Finally, I would say that in order to prepare for tax treaty negotiations, an important aspect is the transparency of the treaty partner, and for that purpose, I will post a link to our Financial Secrecy Index database at the Tax Justice Network. Thank you very much.
Thank you very much, Lucas. We have now time for questions. I don't see many questions that have not been answered in the Q&A function. So waiting for more questions, maybe I make one. Maybe I start with you, Tatiana. I have you on my screen, so sorry. Just one question. One question on your research paper. Do you think that is realistic for developing countries to expect to be able to overturn such as settle international conventions regarding the shipping companies? Because even the tough model, for example, don't have the AB clause. And also related, tax treaties are just basically related to income taxes, and some of the solutions that you're proposing are more related to indirect taxation. So how do you propose to implement these solutions?
Well, starting with the last question, I mean, the research paper really did focus on income taxes. So I mean, the conclusions that I drew at the end was just to make the connection between climate protection and income taxation that we'll have to, bear into account going forward on everything we do in international taxation. So, but the research really concentrated on income taxation, so direct taxation. And with respect to your first question, actually, I think the research itself was very interesting because it in fact showed that despite the general consensus that is out there that Article 8B is ineffective, or that countries, or it's inoperant because it exists in the UN model, but countries actually don't adhere to it. It did show that there is a little cluster of countries that are concentrated in Southeast Asia that are actually implementing it either as a result of treaty practice or just as a result of implementation of domestic tax practices. And I find it interesting that you made the reference to the ATAF model, because I personally believe that's a fallacy of the ATAF model, because they do not, you're correct, completely correct, that they do not contain an alternative 8B style provision in the model. But in fact, almost half of the countries that are ATAF members have posed they have posed a restriction to the application of Article 8 of the ATAF model. So they kind of have remained on their right to differ from the ATAF model if they so intended. So I think it's a topic that is not very well consolidated in countries' treaty practices, especially at the developing country level. There is potential for greater technical expertise from developing country negotiators. And for some countries, I think it would be suitable to understand better the clause and to then understand whether it would be better to include it in tax treaty negotiation practice. And that would obviously depend on where the country is located geographically across the globe, and on a series of other criteria. But certainly greater definition on the model and on the application of that treaty would be very welcome from the UN Tax Committee in order to assist countries in actually assessing whether they want to do so.
Thank you, Tatiana. I don't see any hands raised, so I have another question then. But please feel free to just put the question in the Q&A function or even just raise your hand. This one is for everyone, so I guess we start with Martin, with you. A result from the UCL, if I remember correctly, actually, the paper that I'm mentioning was mentioned in the PCT Toolkit, proposed that the tax treaty should be seen as an instrument for countries that favor residents, just to grant incentives to their companies rather than an instrument that the developing countries are just seeing the taxing rise in favor of the developed ones. What do you think about this statement? And how do you think that that could change the way that that people approach the issue of treaty negotiation?
Thanks. Yeah. So Eric Zolt's suggestion is that we should stop thinking about tax treaties as primarily tools to deal with the problem of double taxation, which leads to the criticism that because this is largely done unilaterally through the residence country's tax system, what tax treaties do is shift the burden of relieving double taxation from one country, from the source country, residence country, to the source country. And he says that's not really what treaties are about. They're about they're a kind of tax incentive that is given to companies from one particular country, and that's how they should be seen. I mean, I think it's a very logical way of seeing tax treaties, because it says let's be clear about how we measure whether these treaties are worthwhile or not. We measure them on the basis of whether they work, in the same way that we do for, we have a lot of experience measuring other tax incentives, trying to, this is a growing part of public financial management, is trying to assess the effectiveness of tax incentives. When are they redundant? When are they not? Trying to quantify the cost of them. If we think about tax treaties in the same way, I think that's really helpful. But I think the point that we have to go on to asking is, really, I think that the question has to be asked not in a blunt way of saying, are tax treaties in general effective as tax incentives, but rather asking more specifically, in what situations is a tax treaty effective as a tax incentive, with which countries, under what conditions, and how does a treaty need to be negotiated to achieve that function? Because my feeling is that there's so many different parts of a treaty which one can make a clear argument for why it makes sense to constrain the source taxing rights in a particular way. But ultimately, if you're asking, by accepting this limitation on source taxing rights, will the treaty stimulate investment or other kinds of economic activity, then you need to ask that on a clause by clause basis. Many of the sacrifices countries make when they sign treaties are probably redundant, even if the treaty itself is not. And so I think that's the next step to go. And I hope we can do more research that starts to study in more detail the precise conditions under which giving up a particular taxing right will or will not have a positive impact on a country.
Well, thank you for that wonderful answer. I see a hand raised, so let me just pose that question and then we can come back to other questions. So if the other of the panelists want to answer also, this question will be good. So Pascal, I don't know if we can unmute him. Is that possible? You are muted. I think you need to unmute. You are still unmuted. Okay. While we solve the muted problem, maybe a question for Mari. A lot of political attention and research on treaties focus on withholding taxes, but this database covers more than that. Do you think that the focus on this withholding taxes reflects the primary importance for revenue, or can other parts of the treaty be just as important?
So thank you, Anna. And actually, when someone, and actually Martin did this, look at our treaty, we see that more of our treaties, and maybe it's about 20 treaties, and we have residency taxation, no source taxation at all in our treaties. And it was mentioned previously that our purpose was to stimulate also encouragement, so the tax investment in our countries. And that's why it depends on what you want to achieve, what kind of country you want. So you are all aware that Georgia is a small economy. So we are strive to limit some kind of tax burden, and we limited number of taxes, and so we are not low tax jurisdiction countries, but quite low in our case, and so we trying to offer investors so a very friendly environment. And for us, you know, when we concentrate on the residency taxation, we thought that it would be one of the effective way to encourage investment, but it is not so. So actually, we changed this policy over the 7 years, and from now we are concentrating on to have source taxation, because to see this, we have 5% in our domestic law source taxation on passive incomes, and that's why we are trying now to keep this 5%, because it is not a separate, you know, if you just see only that, so it is only the one feature and you are investing, attracting investment, it is only workable. So you have the whole package to offer investor, and that's why in most of our treaties which are concluded in that period, maybe 8 years ago, and it is not very far period. It was about 2000, from 2008 until 2012. So maybe it's just 5 years. That time we gave up sourcing taxing, and but you know, now we are trying to revisit our treaties, and now we also have to have in our mind that it is a treaty, was not treaty, but compromised agreement what OECD did in October 8, and now we are all countries in some kind of circle, and we have also to obey the rules what will be effective maybe in 2 years, but it will come, and it is not now. It's up to us to create tax incentives, or to you know, go to lower tax, or to abolish it all, or you know, now we are how to say, but we have some kind of supervising board, I can say, like OECD. Now everyone knows and agree with me that it's changed the international world. Now what we have 10 years ago, we were free, so it's up to us country. If you want to lose anything, it's up to you to go for it. If you want to, just have an agreement with offshore countries, is also. But now everything changed. It's not anymore offshore. We are opening banking secrecy. We are going to make a lot of changes, etc. And that's why I have to recommend our developing countries that they have to accommodate the needs, what is challenging in the world and what will be upcoming at least 3 or 4 years. So we know for sure. And we are all members of the inclusive framework. I will add also this. And so this is my remark.
Thank you, Maureen. Yeah, it's interesting, no? Because I think one big topic going forward, it has been for a while, I think, in the heads of everyone and the work of all of the institutions, is incentives. So incentives need to be rethink very, very quickly, very. Oh, we have a hand. We've lost Pascal, but we have Joseph. Let's try, Joseph, to unmute yourself. I think the IT people need to unmute you, and then you can unmute. Or maybe not. Yes, please.
Oui.
Yes,
Oui.
we can hear you.
Ma question est de savoir, en présence de prix de transfert dans le domaine minier, est-ce qu'on peut se référer au modèle de l'OCDE, à l'article 9, pour fixer ou se référer au principe de pleine concurrence? Merci.
Okay, I didn't hear for who is addressed to everyone or to Martin?
Oui, to everyone.
To everyone?
N'importe qui répondre.
Martin, do you want to start then?
Oh, I'm sorry. Because I'm on the English feed. I didn't quite get the question well enough to be able to answer it.
The question was about the OEC model and the arm's length principle. So whether it's possible to use the use, I was changing interpretation, so I got half and half. But est-ce que vous voulez répéter la question, s'il vous plaît, Joseph?
Oui, ma question est de savoir si on veut connaître les prix qui sont pratiqués entre les sociétés minières ou qui interviennent dans le domaine minier, est-ce qu'on peut se référer à l'article 9 de l'OCDE qui parle du principe de pleine concurrence, du prix de pleine concurrence? C'est ça ma question.
Merci. Did you get it, Martin? Otherwise, I repeat. So for the mining industries, can we use Article 9 in the OECD model?
So, I mean, there may be others who are more able to comment specifically on taxation of the mining industry. It's not a super specialism of mine. But I would say, there's just yesterday, there was the launch of an excellent practice note on tax treaties by the Intergovernmental Forum on Mining, which I think I'll ask if we can post the link to that in the chat for Joseph. But that contains lots of really good guidance on these questions, including areas around how to simplify and ensure that treaties are rigorous. And I think it focuses mostly on other articles rather than Article 9.
Does anyone else wants to try to answer the question? No.
Just quickly. So like, I think that considering the data available in the Tax Treaties Explorer, I think that one of the most important provisions with regards to mining companies would be the taxation of capital gains on land-rich companies. So it would be good, like to survey how African countries do with regards to that provision. with regards to the arm's length principle, I'm not sure that it's a good way to tax the income of those companies. Thank you.
I'm not a tax treaty expert, but I have someone just trying to help me here. But maybe in the application of Article 9 is more important to look at the articles about a chain of information for the information that you will need with the related parties. That could be also a way, it's more straightforward. Est-ce qu'on avait répondu à votre question, Joseph? Let me ask Lucas. Lucas, I have you on my screen. So it was very interesting, your presentation about the aggressiveness of the treaty. So can you explain us a little bit the connection between this concept of aggressiveness and the treaty shopping? And should a country be more concerned with aggressive treaty with a capital exporter or a less aggressive treaty with a conduit country?
Okay, so I think that like aggressiveness and treaty shopping are very closely related, in the sense that it would be in the interest of a tax minimizing multinational to structure its economic activities through aggressive treaties, meaning that like an aggressive treaty is that which reduces source taxation the most in comparison to other treaties. So that would be the treaty that would be most most useful for a treaty shopping. But of course, like as you say, like the difference between like just like a capital exporting country and a conduit country would be how the let's say back-to-back arrangements and conduit activities would be allowed in that country. So like for instance, France might not allow to the same extent as Luxembourg for profits that have come in to then go out. No, so like in that sense, it's different to sign with any capital exporting country or with specifically a conduit country. Yeah, thank you.
Thank you very much. I apologize, I've been just hijacking the question and answer session. Maybe very quickly, we are almost over, but very quickly, just to finalize, to conclude, Martin, can you tell us about more what we can do with this database, this new database that you presented and is available in French, and he was telling me that it will be available soon in Spanish. So very quickly to conclude this event, could you tell us what are you hoping to get in the future with this data, please?
Sure. So let me say two things. The first is we're really, we can see from the UC statistics that it's getting a lot of use from around the world, and that's really great. We would really welcome any feedback from people who've used it to help us gain an idea of how we can strengthen it and make it more relevant and useful to policymakers and treaty negotiators and others. Then in terms of research, as I said, we held a workshop last week. We have a number of interesting projects that have been proposed. And I think there's a few things that we want to do, both with this data and more broadly. So I think there's been a lot of progress made developing the approach to designing complicated econometric studies that try to measure the impact of treaties. And I think to some extent they've gone really a long way in controlling for treaty shopping and in controlling for the use of conduit jurisdictions and defining what makes a treaty relevant or not for an investor. But I think there's two or three things that we now need to do. The first is to use the data we've compiled to ask the question I mentioned earlier. So when do the terms of a treaty matter, and when do the terms not matter? It just matters having a treaty, and when does in fact none of it matter for an investor? And that's the first important question. A second important question, and a bit data we don't yet have, is on the domestic tax systems of countries and how they relate to treaties. So, for example, it would surely be the case that an investor is much more interested in the withholding tax rates in a treaty if they're much lower than the statutory rate in domestic law. But if the withholding tax rates are in fact low, but the same as in domestic law, the treaty may not have any impact. So we need to build a data set that allows us to study that, and it's that's an ongoing project. And then I think the third thing is to understand a bit more about how treaties impact on investment, on other economic flows. So, for example, on provision of services, on portfolio flows rather than direct investment flows, because one of the things we learned in the workshop was that it may often be third-party funding of local businesses that is affected by treaties rather than direct investment within a multinational. And so modeling that will be interesting. And I was just wondering in terms of Tatiana's research, for example, when a country is considering how hard to fight for the right to tax shipping, do we anticipate that having source taxation of shipping will have any negative economic impact? Or is it purely about the political bargain struck between the countries as to in order to get the treaty at all? So I think there are probably some clauses where we could say they do have a direct impact on some kind of economic activity, and others that don't and are purely about the politics of the negotiation.
Thank you very much. I think that those are very important takeaways. I don't think I have much more to say there, only maybe to thank you everyone. Thank you also for the recommendations, especially for Mary, about how we can improve the work that we are doing related to this database and also in the platform for collaboration on tax. And the remarks that they have made a difference that she was mentioning, and I was writing down that when she was treaty negotiator, she wished that she had this information not beforehand. So I think with that, we can conclude the event. Maybe I invite Martin to say a final word before we say bye.
Only to say thank you to everyone for coming. Thank you to everyone who spoke and who's already done work using this data set and this tool, and thank you to the World Bank and the G24 for their support for this project. And I wish you all a good afternoon, evening, or morning.
Thank you very much then. Thank you. Bye-bye. Take care.
Bye.
Thank you. Bye.
Bye. Thank you very much.
And thank you to the translators. Thank you very much.